Welcome back to the Deep Dive. Today we're diving into the world of trading and market analysis, a topic you've clearly got a keen interest in. You sent over a fascinating mix of materials, including excerpts from Trading for a Living. I'm excited to unpack this with you.
It's a treasure trove of knowledge for sure. Trading for a living does a great job of laying out a framework for approaching the markets, not just from a technical standpoint, but also from a psychological one.
Okay, let's dive into that framework. The book talks about the three pillars of successful trading. It feels like a good place to start, right?
Absolutely. The three pillars are psychology, market analysis, and risk management. And what's fascinating is that most new traders tend to get hyper-focused on market analysis. They're searching for that one magic indicator that will unlock the secrets of the market.
Yeah, I get that. It's tempting to think there's some holy grail out there that can predict the future. So why are the other two pillars so important?
Well, think about it this way. Even if you had a crystal ball that told you exactly which way the market was going to move, you still wouldn't be guaranteed to make money. Your psychology, your ability to manage your emotions, your discipline is absolutely crucial. Fear and greed can lead to impulsive decisions that wipe out your gains.
So it's not just about being right. It's about staying level-headed enough to actually execute the trades when it counts.
And what about risk management? Where does that fit in?
Risk management is your safety net. Even with a sound trading strategy and a calm mind, a few bad trades can absolutely decimate your account if you don't manage your risk properly.
Okay, I'm starting to see how these pillars are interconnected. It's not just about picking the right stocks, it's about having a holistic approach to trading. Now, trading for a living also spends a good chunk of time talking about crowd psychology. Why is that such a big deal in trading? Because markets are driven by human behavior at their core, and when you have a huge number of people interacting in the market, their emotions, their fears, their greed, their hopes get amplified. The book uses the term primitive to describe crowd behavior, almost like a herd of animals reacting instinctively.
Interesting. So is the key to success trying to predict how the crowd will react next?
It's more nuanced than that. It's not about predicting the next move, so much as understanding the forces at play. Take the concept of market cycle gurus, for instance. These are the individuals who seem to have a knack for calling market tops and bottoms, often gaining massive followings during bull markets.
Oh yeah, everyone loves a guru when the market's going up.
Yeah.
But the book suggests there's more to it than that, right?
Exactly. What often happens is these gurus simply reflect the dominant sentiment of the crowd. Their popularity is more about the crowd's psychological need for reassurance and leadership during those euphoric times than any special insight. Recognizing this tendency can help you avoid getting swept up in the hype and making irrational decisions.
That's a really interesting point. So it's about being aware of those psychological currents. They're always swirling beneath the surface of the market. Now let's shift gears a bit and talk about some of the more technical aspects of trading. The book covers a lot of ground here, but one of the foundational concepts it introduces is support and resistance. Can you explain that for our listener and why it's so important?
Think of support and resistance as the battle lines between buyers and sellers. Support acts like a floor under the price. It's a price level where there's typically enough buying interest to prevent further declines. Resistance, on the other hand, is like a ceiling, a price level where selling pressure tends to halt further advances.
Okay, so support is where buyers step in, and resistance is where sellers take over. I can see how that would create these push and pull dynamics in the market, and these levels are visible on price charts, right?
Absolutely. You can literally see these zones where the price struggles to break through. And here's where it gets really interesting. The longer the time frame you look at, the more significant those support and resistance levels become. A resistance level on a weekly chart, for example, is much more powerful than one on a 5-minute chart because it represents a larger accumulation of buying and selling pressure.
Okay, that makes sense. So if I'm looking for a truly significant resistance level, I should zoom out on the chart and look at a longer time frame.
Exactly. Always consider multiple time frames. It's all about context.
That's a good point. Now, remember, the book also mentions these things called false breakouts that can happen around support and resistance levels. What's that all about? And how can understanding those help someone make better trading decisions?
A false breakout is fascinating. Let's say the price dips below a support level, seemingly breaking through, but then it quickly rallies back above that level. This kind of move often signals that the sellers tried to push the price down, but the buyers were too strong. It can be a powerful buying signal.
So it's not just about watching for the break. It's about watching how the market behaves after the break. That's a really valuable insight. Now, another key concept that trading for a living dives into is moving averages. I know there's some kind of average of past prices, but I've always struggled to understand how they're actually used in trading.
Moving averages are like dynamic support and resistance lines. They smooth out the price fluctuations and help you visualize the underlying trend. For instance, a rising 10-day moving average suggests an uptrend and can act as a potential support level. Conversely, a falling 200-day moving average might signal a downtrend and act as resistance.
Okay, so the moving average is like a trend line that follows the price action. And by looking at where the price is relative to these moving averages, I can get a sense of the strength or weakness of the trend. What I find really intriguing, though, is this concept of divergences that the book talks about.
Divergences are fascinating and potentially very profitable. Imagine this. The price of a stock is making a new low, but an indicator like the Massey histogram is starting to turn up. This disconnect, the price going down, while the indicator is suggesting a potential shift in momentum, is a divergence.
So it's like the price is telling one story, but the indicator is whispering a different one. What makes divergences so useful for traders?
Divergences can be powerful early warning signals of potential trend reversals. Trading for a living actually shows a striking example of a bullish divergence that formed at the 2009 stock market bottom. The price was making new lows, painting a picture of despair. But the Mackey histogram was hinting at a possible shift in momentum, a glimmer of hope. It's these subtle clues that can give you an edge.
Wow, that's a powerful example.
Uh.
And by learning to spot these divergences, we can potentially anticipate those major turning points in the market. This is starting to get really interesting.
It is, but remember, no single indicator is perfect. It's about using multiple tools to confirm your analysis and using those insights to make more informed trading decisions.
Okay, so we've got crowd psychology, support and resistance, moving averages, and divergences. We're starting to build a toolkit for understanding the markets. Now, I know the book also talks a lot about the importance of volume. Help me understand this. I know volume is simply the number of shares or contracts traded. But why is it so crucial in trading? And how can we use it to our advantage?
Volume is the fuel that drives price movements. It gives you a measure of the conviction behind those moves. Think of it this way. Price tells you what people are thinking, but volume tells you how strongly they feel about it.
So a big price move on huge volume is a much stronger signal than the same move on low volume, because it shows there's a lot of conviction behind that move.
Exactly. High volume confirms the strength of a move, while low volume can be a warning sign that a trend is losing steam or that a breakout might be a trap. It's like reading the market's body language.
Okay, I'm starting to get it. Volume is like the emotional energy of the market.
Yeah.
Now, the book introduces this interesting indicator called the force index. What is it, and how does it incorporate volume into the analysis?
The force index is brilliant because it combines price changes with volume. To give you a deeper understanding of the forces at play, it essentially measures the power of the bulls and bears, telling you who's in control.
So if the force index is rising, it suggests the bulls are in charge, and if it's falling, the bears are running the show.
You got it. But here's what makes it particularly useful. Just like with the Mackey histogram, divergences in the force index can act as early warning signals of potential trend reversals. It's another tool for spotting those subtle shifts in momentum before they become obvious to everyone else.
This is amazing. We're looking at price, volume, and indicators, all to get a sense of the crowd's emotional state and where the market might be heading next. This is like learning to speak the market's language.
That's a great way to put it. And remember, trading for a living stresses that no indicator is perfect in isolation. It's about using multiple tools to confirm your analysis and understanding the psychology behind the numbers.
Now, speaking of reading the crowd, the book also talks about something called consensus and commitment indicators. What are those, and how can they help us understand the market's mood?
These are tools that track the sentiment and positioning of different groups of market participants. For example, you can look at the consensus among financial journalists. They're often wrong, especially at extremes.
I bet. I can imagine when everyone's super bullish, that might actually be a sign of trouble brewing, right?
Often, yes. When a huge majority of financial journalists become overly bullish or bearish, it can be a contrarian signal, suggesting the trend is nearing exhaustion. It's like that old saying, when the shoe shine boy starts giving stock tips, it's time to sell.
I love that analogy. So it's about looking for those subtle signs that the crowd is getting too complacent or too fearful. It's almost like contrarian thinking applied to market sentiment.
Exactly. The book gives a fascinating example of how tracking the dollar volume of penny stocks can be a contrarian indicator for the broader market.
Wait penny stocks. So when people are piling into those super risky speculative plays, it might actually be a sign that the overall market is getting overheated.
Precisely. Remember, understanding crowd psychology is all about recognizing these subtle shifts in sentiment and using those insights to make better trading decisions.
Okay, that's incredible. But let's face it, even with all this knowledge about crowd psychology and market analysis, there's one crucial element we haven't addressed yet. The element that can make or break
Yeah.
even the most skilled trader. And that's risk management, right?
You're absolutely right. It doesn't matter how good your analysis is or how well you understand crowd psychology. If you don't manage your risk properly, a few bad trades can wipe you out completely. It's the foundation upon which everything else is built.
So before we even think about placing a trade, we need to have a rock-solid risk management plan in place.
Absolutely. And trading for a living introduces a simple yet powerful principle for managing risk. The 2% rule.
Okay, I've heard of the 2% rule, but honestly, I'm a little fuzzy on the details. Can you break it down for us and why it's so essential for protecting our capital?
Of course. The 2% rule is all about limiting your risk on any single trade to just 2% of your total account equity. So if you have a $50,000 account, you shouldn't risk more than $1,000 on any single trade, no matter how confident you feel.
Okay, that makes sense. So it's like setting a hard limit on how much I'm willing to lose on any given trade. But how do I actually calculate my position size based on that 2% risk limit?
That's where your stop loss level comes in. You divide that $1,000 risk by the distance between your entry price and your stop loss level. So if your stop loss is $2 away from your entry, your maximum position size would be 500 shares.
Okay, I see. So the tighter my stop loss, the smaller my position size needs to be. To stay within that 2% risk limit, it's a brilliant way to automatically adjust my position size based on my risk tolerance and the volatility of the market I'm trading.
Exactly. And to further protect your capital, the book also introduces the 6% rule, which limits your total risk across all open trades to 6% of your account equity per month. This adds another layer of protection and helps you avoid those devastating drawdowns that can wipe out months or even years of hard-earned profits.
Wow, that's a great way to put guardrails around my trading and prevent those emotional decisions that can lead to disaster. I'm starting to understand why risk management is so fundamental to success in trading. It's not just about making money. It's about protecting the money you've already made.
You've got it. And remember, trading for a living emphasizes that risk management is not just a set of rules. It's a mindset, a commitment to preserving your capital so you can stay in the game for the long run.
Okay, so we've covered a lot of ground here, from the psychological aspects of trading
Hmm.
to the technical tools, and of course, the importance of risk management. It's amazing how all these elements work together to create a comprehensive approach to the markets.
It is. And in trading for a living, the journey continues with a deep dive into the importance of keeping a trading journal. And something that sounds pretty interesting, grading your trades.
Grading trades like in school.
I'm
I'm intrigued. Before we dive into that, though, let's take a quick break. We'll be right back with more from our deep dive into trading for a living. All right, we're back and ready to continue our deep dive into trading for a living. Before the break, we were about to explore this idea of grading our trades. I'm really curious about this. It sounds like a powerful way to hold ourselves accountable and learn from our experiences in the market.
It is. Think of trade grading as a way to move beyond simply tracking wins and losses. It's about evaluating the quality of your trading decisions and identifying areas where you can improve.
Okay, I like that. So how does this grading system actually work? What are we measuring here?
It's actually quite simple. You're essentially comparing your performance on a trade to the potential that was available on the entry day. You use the width of the trading channel on that day as a benchmark.
So if I entered a trade near the bottom of the channel and rode it all the way to the top, that would be an A-plus trade.
Exactly. You captured the full potential move. But if you only manage to capture a small portion of that move, it might be a C or even a D trade. The point is to be honest with yourself about how well you executed the trade, regardless of whether you made or lost money.
I'm starting to see the value in this. It's not just about the outcome, it's about the process. And trading for a living suggests keeping a detailed trading journal where you can record these trade grades right.
Absolutely. Your trading journal is your most valuable tool for growth. It's where you record all the details of each trade, your entry and exit points, your stop loss and profit targets, your emotional state, and of course your trade grade. By reviewing your journal regularly, you can start to identify patterns in your trading behavior, both good and bad.
It's like having a personal coach who's tracking your every move and giving you feedback on your performance. The book actually shares a personal anecdote about how reviewing the trading journal led to some really valuable insights.
Yes. For example, it helped identify the need to adjust stop-loss levels, to reduce whipsaws, those frustrating trades where you get stopped out just before the market turns back in your favor.
Ouch. I've definitely experienced those whipsaws before. And they can be brutal. It makes sense that by analyzing your trading journal, you can start to spot patterns in your behavior that might be leading to those whipsaws, and then adjust your strategy accordingly.
Precisely. It's all about continuous learning and improvement.
Okay, I'm convinced. Trading journal check. Trade grading check. Now, I know trading for a living gets into some specific trading systems, and one that caught my eye was the triple screen trading system. It sounds intriguing, but also a little intimidating. Can you break it down for us?
The triple screen is a powerful yet elegant approach. Don't let the name scare you. It's essentially about using 3 different time frames, weekly, daily, and intraday, to confirm your trading decisions, reducing the risk of impulsive entries.
Okay, so it's like a multi-layered approach to analysis.
Yeah.
I like that. Can you walk me through how it actually works? What are we looking for on each of these charts?
Imagine it like this. The weekly chart gives you the big picture, the overall trend. You're looking for a strong, sustained move in one direction or the other, establishing the direction of the tide.
Okay, so we're establishing the context for the trade. What happens next?
Once you've identified the weekly trend, you move down to the daily chart. This is where you start looking for a potential trade setup. That aligns with the broader trend, for instance. If the weekly trend is up, you'd be looking for buying opportunities on the daily chart.
So if the weekly chart is showing a bullish tide, we're riding that wave on the daily chart. Got it. What about the intraday chart? Where does that fit in?
The intraday chart, maybe a 5-minute or 15-minute chart, is your fine-tuning tool. It helps you pinpoint your entry and exit points, set your stop-loss levels, and manage risk more precisely. It's about timing your entry to catch the best part of the wave.
So the triple screen is like having 3 different lenses through which we view the market. The wide lens for the big picture, the mid-range lens for the setup, and the zoom lens for execution.
That's a great way to put it. And Trading for a Living recommends using a combination of moving averages and the MACD histogram on the daily chart. To identify those potential entry points, it calls this the impulse system.
Okay, so the impulse system helps us time our entry and jump on board the market's momentum. What I find particularly interesting about the triple screen is that it forces you to consider the market from multiple perspectives before making a trade.
Exactly. It's a built-in system for avoiding impulsive decisions. Now, Trading for a Living also introduces another trading system called the channel trading system. Any guesses what that might involve?
Based on the name, I'm guessing it has something to do with identifying and trading within channels on a price chart, right?
You got it. The channel trading system focuses on those periods when a market is oscillating between clear support and resistance levels, creating a distinct price channel.
It was about identifying those moments when the market is range-bound, kind of like a bouncing ball, between those support and resistance levels, rather than trending strongly in one direction.
Precisely. And once you've identified a channel, you can look for buying opportunities near the lower boundary of the channel and selling opportunities near the upper boundary.
So it's about buying low and selling high within that defined range. It sounds almost too simple, but I'm guessing there's more to it than meets the eye.
You're right. The channel trading system incorporates a concept called standard deviation, which measures price volatility, to define those channel boundaries more precisely. One popular way to construct these channels is using Bollinger Bands, which are based on those standard deviation calculations.
Okay, so Bollinger Bands provide a more objective, mathematical way to define the upper and lower boundaries of that trading range. That's super helpful. The book also mentions something about symmetrical channels. Why is symmetry important?
Symmetry in a channel suggests a balanced market, a sort of equilibrium between the bulls and bears. This can lead to more predictable price oscillations within the channel, making it easier to identify those high-probability trading opportunities. It's like finding a market that's rhythmically moving back and forth.
Got it. So we've got 2 distinct trading systems here. The impulse system for riding those trending waves, and the channel trading system for capitalizing on those range-bound bounces. It seems like a well-rounded approach to different market conditions.
Exactly. And Trading for a Living emphasizes that these systems are not mutually exclusive. You can adapt and combine them based on your own trading style and the prevailing market conditions.
Okay, so it's not about finding the one perfect system. It's about having a toolkit of strategies and knowing when to apply them. Now, up until now, we've been talking mainly about trading stocks. But what about those other markets out there, like Futures and options. Does trading for a living cover those too?
Absolutely. Trading for a Living dedicates an entire section to exploring different trading vehicles, from futures and options to ETFs and even Forex. It's a great overview of the pros and cons of each market and how they can be used to achieve different trading objectives.
Let's start with futures. I know they're contracts to buy or sell an asset at a future date, but honestly, I find them a bit confusing. Can you explain how they're actually used in trading and why someone might choose to trade futures instead of stocks?
Think of futures as a way to leverage your capital and gain exposure to a wide range of assets, from commodities like gold, oil, and agricultural products, to financial instruments like stock indexes, bonds, and currencies. You can trade futures on practically anything.
Wow, that's a lot of options.
Yeah.
But what are some of the key differences between trading futures and trading stocks?
One major difference is that futures contracts have a specific settlement date. Unlike stocks, you can't just hold on to a futures contract forever. You either have to close out your position before the contract expires or take physical delivery of the underlying asset.
Taking physical delivery, I can't imagine many people actually do that.
You're right, most futures trades are settled in cash. Another key difference is that futures markets often have daily price limits. It's a mechanism designed to prevent those wild, out-of-control price swings that can happen in a single trading session.
So it's like a circuit breaker for the market,
Yeah.
preventing those panic-driven moves. That makes sense. But what about the leverage aspect? How does that work with futures?
Leverage is a double-edged sword. It allows you to control a larger position with a smaller amount of capital, magnifying your potential profits. However, it also magnifies your potential losses. So it's crucial to use leverage responsibly and to have a solid risk management plan in place.
Okay, that's a good reminder. Leverage can be tempting, but it's definitely not for the faint of heart. Now let's move on to options. I know they give you the right, but not the obligation, to buy or sell an asset at a certain price. But I've always found them a bit intimidating. Can you break down the basics for us?
Absolutely. You have two basic types of options, calls and puts. Calls give you the right to buy an asset at a specific price, and puts give you the right to sell. What makes options so fascinating is this concept of time value, which decays as the option approaches its expiration date.
Time value. So an option is worth more the further away it is from expiring. That's interesting.
Exactly. The further out the expiration date, the more time the underlying asset has to move in a favorable direction. Now, trading for a living highlights a particular options strategy called writer's choice. It involves selling options rather than buying them.
Writer's choice, huh? Why would someone choose to sell options rather than buy them? Isn't that riskier?
The idea behind writer's choice is to profit from the decay of time value. By selling an option, you collect a premium upfront. If the option expires worthless, you get to keep that premium.
So if I sell a call option, I'm essentially betting that the underlying asset won't rise above a certain price before the option expires. And if I'm right, I keep the premium as my profit.
Precisely. In this case, time is on your side. However, it's important to note that while the potential reward for selling options can be significant, so too is the potential risk. If the market moves against you, your losses can be substantial.
Okay, that makes sense. So it's crucial to have a deep understanding of options and a well-defined risk management plan before jumping into a strategy like writer's choice. Now, what about those ETFs we hear so much about these days? They seem to be all the rage.
ETFs, or exchange-traded funds, are basically baskets of assets, stocks, bonds, or commodities that are bundled together and trade like individual stocks. They've exploded in popularity because they offer investors a convenient way to diversify their portfolios.
So instead of trying to pick individual stocks, I could buy an ETF that tracks the S&P 500, the NASDAQ 100.
Yeah.
It's like instant diversification with just one trade. I could see the appeal.
Exactly. And there are ETFs for practically every sector, country, or investment theme you can imagine. However, trading for a living does point out a potential drawback with ETFs. They're a two-tiered market structure.
Two-tiered market structure. What does that mean? Is it something I should be worried about?
Here's the thing. Large institutional investors have access to a primary market for ETFs, where they can get better pricing than individual investors. In the secondary market, it's not necessarily a deal breaker, but it's something to be aware of.
Okay, so it's not a perfectly level playing field. Noted. Now, the last trading vehicle the book explores is Forex, the foreign exchange market. I know it's the largest financial market in the world, but I've also heard it can be quite risky.
Forex trading definitely carries its share of risk. The markets are incredibly volatile and can move very quickly, which can be both exciting and dangerous. And one of the things trading for a living cautions against is trading Forex through brokers that operate as market makers.
Market makers, what does that mean? And why should we be wary of them?
A market maker is essentially taking the other side of your trade. So if you're making money, they're losing money, and vice versa. This creates a potential conflict of interest. Trading for a living recommends considering currency futures instead, as they offer greater transparency and regulatory oversight.
Okay, that's a valuable tip. So if I'm thinking about dipping my toes into the Forex market, I should stick with currency futures and avoid those market maker brokers. Got it.
Yep.
But now I'm feeling a little overwhelmed. We've covered so many different markets and trading vehicles. Stocks, futures, options, ETFs, Forex. How do I even begin to put all of this together?
That's where having a clear trading plan comes in. Trading for a living provides some really helpful guidance on developing a trading plan, and it all starts with defining your trading style.
Trading style. Okay, tell me more about that. What are the different styles, and how do I figure out which one's right for me?
It's all about aligning your approach with your personality, risk tolerance, and time commitment. Are you a trend follower? Someone who rides the waves of momentum? A contrarian who bets against the crowd? A swing trader who holds positions for days or weeks? Or a day trader who's in and out of the market within hours?
Okay, so it's about understanding my own temperament and how I like to approach the markets once I've figured out my style. What's next?
The next step is to select the markets and timeframes that align with your chosen style. If you're a swing trader, you might focus on daily or weekly charts of stocks. A day trader, on the other hand, might look at 5-minute charts of futures or Forex.
So it's about finding the right playground for my trading style. I like that. What about the actual trading rules? How do I develop those?
Your trading rules are the backbone of your plan. They dictate your entry and exit points, your stop-loss levels, your position sizing, everything. Trading for a living suggests developing clear, concise rules that leave no room for interpretation, helping you stay disciplined and avoid emotional decisions.
So it's about taking the emotion out of trading as much as possible. And of course, we can't forget about risk management.
Absolutely. Your risk management plan should include those stop-loss levels and position sizing rules we discussed earlier. It's all about protecting your capital so you can stay in the game for the long haul.
Okay, so I've got my trading style, my markets and time frames, my trading rules, and my risk management plan. What's next? Do I just jump right into the market and start trading with real money?
Hold on a second. Trading for a living recommends testing your plan thoroughly before risking your hard-earned capital. One way to do that is through paper trading, which lets you simulate trades in a risk-free environment.
Yes. Paper trading. It's like a dress rehearsal for the real thing. But is paper trading enough?
Paper trading is a great starting point, but trading for a living also suggests backtesting your system on historical data.
Backtesting. That sounds intriguing. What's that all about?
Imagine you have a time machine for the markets. Backtesting is like running your trading system through that time machine to see how it would have performed in the past. It helps you identify potential weaknesses in your system and refine your approach before risking real money.
That's amazing. It's like stress testing your system to make sure it can handle different market conditions. But one thing I worry about is making my system too complicated. Is that a common pitfall?
Absolutely. Trading for a living cautions against complexity. Overly complicated systems with too many indicators and rules often fail in real-time trading. They're too rigid and can't adapt to the market's ever-changing dynamics.
So it's back to the KISS principle. Keep it simple, stupid.
Exactly. Focus on a handful of high-quality indicators and rules that you understand deeply, and avoid trying to incorporate every trading concept you come across.
Got it. Less is more. Now, the book also talks about this idea of trade bills. What are those? And how can they help someone become a more disciplined trader?
Trade bills are essentially checklists designed to help you make more objective and rational trading decisions. Think of it like a pilot's pre-flight checklist. Before you take off on a trade, you go through your trade bill, making sure you've considered all the key factors.
I love that analogy. So it's about having a systematic process for evaluating each trade idea and avoiding those impulsive decisions driven by fear or greed. What kind of information would typically go on a trade bill?
Your trade bill should include details like the market you're trading, the time frame you're using, your entry and exit signals, your stop loss and profit target levels, your position size, and your rationale for the trade.
So like a complete record of my thought process.
Yeah.
And my trading plan for each trade. It's a brilliant way to stay organized and accountable. Now, the book also discusses the importance of scanning for potential trades. What does that mean? And are there any tools that can help us with that?
Scanning is simply the process of reviewing a group of trading vehicles, stocks, futures, options, and identifying those that meet your specific criteria. There are tons of scanning tools available these days, both online and through trading platforms. You can set up scans to alert you to stocks breaking out above resistance, stocks with unusual volume, options with high implied volatility, you name it.
Wow, that sounds like a huge time saver. It's like having a personal assistant who
Hmm.
filters through thousands of potential trades and only presents you with the ones that fit your criteria.
Exactly. But trading for a living cautions against relying solely on scanners. They should be a starting point, not an end point.
Okay, that makes sense. A scanner might flag a stock that looks great on paper, but there might be other factors,
Yeah.
maybe something in the news or a fundamental issue with the company that make it a bad trade in reality.
Exactly. Always trust your own analysis and due diligence. Now, the book then shifts gears a bit and talks about the importance of establishing a daily homework routine.
Daily homework. I thought we were done with homework after school. Tell me about this daily homework for traders. What does it involve, and why is it so important?
Think of your daily homework as your pre-market preparation. It's about getting your head in the game and setting yourself up for success. Trading for a living suggests using a spreadsheet to organize your routine, checking things like overseas markets, reviewing major news headlines, analyzing key currencies and commodities, and gauging the overall market sentiment.
So it's about getting a sense of the global financial landscape before
Yeah.
the U.S. market opens and identifying potential opportunities or threats that might impact my trading decisions.
Precisely. It's about being proactive and prepared, rather than reacting to the market's every move. And speaking of helpful tools, Host, the book also introduces something called trade app GARs.
Trade app GARs. That sounds intriguing. What are those?
Think of trade app GARs as a scoring system for evaluating the strength of a potential trade setup. You answer a series of questions about the market, the time frame, the indicators, and the overall setup. Each answer receives a score, and then you tally them up to get an overall APGAR score.
Okay, I'm starting to see how this works. So a high APGAR score would suggest a strong setup, a green light to proceed with the trade, while a low score would be a yellow or red flag, warning me to be cautious. It's like a filter to help me separate the good trade ideas from the bad ones.
Exactly. It's another tool for adding objectivity to your trading decisions.
Okay, so we've got trade bills for making trading decisions and trade APGARs for evaluating setups. What about keeping track of all those trades? Is there a specific way we should be doing that?
That's where the trading journal comes in. We touched on it briefly earlier, but trading for a living really emphasizes the importance of keeping a detailed record of every trade, from entry to exit. It's not just about tracking wins and losses, it's about understanding your behavior and identifying patterns. That can help you improve.
I've heard that before. But honestly, I still struggle to understand why it's so important. Isn't it enough to just track my overall profit and loss?
Not at all. The trading journal is your personal laboratory, a place to experiment, track your results, and refine your approach. It's where you can see which strategies are working, which ones are failing, and where you might be making costly mistakes.
Okay, I'm starting to see the bigger picture here. It's not just about the numbers. It's about understanding the why behind those numbers. Why did I enter this trade? What was my emotional state? How well did I execute the trade? The trading journal allows us to answer those questions and become more self-aware as traders.
Precisely. And trading for a living suggests recording a ton of information in your journal: the market you're trading, the time frame, your entry and exit points, your stop loss and profit target levels, the trade grade, and even your rationale for the trade.
Wow, that's a lot of detail. But I can see how having all of that information at your fingertips would be incredibly valuable for identifying those subtle patterns in your behavior and refining your approach. It's almost like having a therapist for your trading.
I love that analogy. And the book also emphasizes the importance of regularly reviewing your trading journal, not just recording data, but analyzing it. One key metric it recommends tracking is your equity curve, which is a visual representation of your trading account balance over time.
Okay, so the equity curve shows me the big picture, whether I'm winning or losing over the long run. But trading for a living suggests going even deeper, right?
Exactly. It recommends analyzing separate equity curves for specific markets, trading strategies, and even different exit tactics. This helps you identify your strengths and weaknesses as a trader and determine which approaches are consistently profitable.
It's about getting granular with your analysis and understanding the nuances of your performance. It makes sense that some strategies might work better for certain markets, or that certain exit tactics might be more profitable than others.
Exactly. The more data you collect and analyze, the more you can refine your approach and optimize your trading performance.
This is incredible. We're talking about using data not just to track our performance, but to understand ourselves as traders, our
Mm,
strengths and weaknesses, our emotional patterns, and ultimately to make better decisions in the market.
you've got it. And trading for a living really emphasizes that data-driven self-awareness is a key component of successful trading. It's about removing the ego and looking at your performance objectively, almost like a scientist conducting an experiment.
I love that.
Yeah.
And it makes sense that by embracing that scientific mindset, by
Mhm.
tracking our data and analyzing our behavior, we can continuously evolve as traders
Mm.
and move closer to those long-term goals of consistency and profitability.
Absolutely. Trading for a living goes beyond the technical aspects of trading and delves into the psychology, highlighting the importance of self-awareness and discipline. The author argues that successful trading requires a unique blend of drive, knowledge, and
What?
discipline.
Drive, knowledge, and discipline. Those sound like essential qualities for success in any field, not just trading.
You're absolutely right. But in trading, these qualities are especially crucial because the market is constantly testing our emotions, our resolve, and our ability to stick to our plan. It's a mental game as much as it is a financial one.
Okay, I can see that. The markets can be incredibly tempting and incredibly frustrating, often at the same time. It's easy to get caught up in the emotional roller coaster and make impulsive decisions.
Exactly. And one of the challenges that traders face, especially those who are trading independently, is that they often work alone. Without the support and structure of a traditional job, it's easy to feel isolated and to get lost in your own thoughts and emotions.
Yeah, I can imagine that feeling of isolation can be tough to deal with, especially when you're going through a rough patch in your trading.
Exactly. And that's why trading for a living emphasizes the importance of having a supportive community of fellow traders or mentors who can provide guidance, encouragement, and a sense of perspective. It's like having a team, even if you're trading solo.
So it's about building a network of people who understand the unique challenges of trading and who can help you stay grounded and focused on the long-term goals.
Precisely. And the book also highlights the importance of having a life outside of trading. It's about finding that balance between your passion for the markets and the other aspects of your life that bring you joy and fulfillment.
That makes a lot of sense. It's easy to get obsessed with trading, especially when you're first starting out, but it's crucial to maintain those connections with the outside world and to have activities that help you de-stress and recharge.
Exactly. Trading should be a part of your life, not your entire life.
Okay, so we've talked about the importance of psychology, self-awareness, and building a support system. Now, I know trading for a living also discusses some common fantasies that traders often fall prey to. What are those fantasies, and why are they so dangerous?
These fantasies are seductive because they offer the allure of a shortcut to success. But the reality is there are no shortcuts in trading. It's a journey that requires hard work, dedication, and a willingness to learn from both your successes and failures.
Okay, spill the beans. What are some of those fantasies that we need to be aware of?
One common fantasy is the autopilot myth. This is the belief that you can find a trading system so perfect that it will generate profits automatically, without any effort on your part. It's the dream of passive income, of becoming a millionaire while you sleep.
Ah, yes. The elusive set it and forget it trading system.
Hmm.
I can see how that would be a tempting fantasy. So why is it a myth?
The reality is no system is perfect, and markets are constantly evolving. Even the best trading systems require ongoing monitoring, adaptation, and
Yeah.
refinement. Trading is not a passive activity. It requires active engagement, constant learning, and a willingness to adjust to changing conditions.
So there's no magic bullet, no holy grail that will make us rich overnight. It's about putting in the work, staying informed, and being willing to adapt.
Exactly. Another common fantasy is the brain myth, the belief that intelligence alone is enough to guarantee success in trading.
So just because I'm smart doesn't mean I'll be a good trader.
Not necessarily. Trading requires a different kind of intelligence, emotional intelligence. It's about managing your emotions, controlling your impulses, and staying disciplined even when the markets are testing your nerves.
I can see that. The markets can be incredibly emotional, and it's easy to get swept up in the euphoria of a winning streak or the despair of a losing streak. It takes real mental toughness to stay grounded and stick to your plan.
Exactly. And ironically, sometimes intelligence can actually be a hindrance in trading. It can lead to overconfidence,
Ooh.
arrogance, and a reluctance to admit when you're wrong. Humility is a valuable asset in the markets.
So it's not just about what you know. It's about how you manage your emotions, how you react to adversity, and how you learn from your mistakes.
Precisely. And another fantasy trading for a living warns against is the cult of personality trap.
Oh, this sounds juicy. Tell me more.
This trap involves blindly following a charismatic guru or trading expert, believing they hold the secret to riches. We touched on this earlier with the market cycle gurus.
Right. Those folks who seem to have a knack for predicting market tops and bottoms. But the book suggests that blindly following these gurus can be dangerous, right?
Absolutely. It's easy to get swept up in the charisma and the promises of quick riches, but ultimately you're surrendering your own judgment and decision-making to someone else,
Yeah.
and that can be a recipe for disaster.
Okay, so it's about developing our own critical thinking skills and not blindly accepting anyone's advice, no matter how successful or charismatic they may seem.
Exactly. Remember, no one cares about your money as much as you do.
That's a great point. So it's about taking responsibility for our own financial decisions and not relying on anyone else to make those decisions for us.
Precisely. Now, another fantasy that trading for a living debunks is the undercapitalization myth.
Undercapitalization, what's that all about?
This myth feeds on the get-rich-quick mentality. That lures so many people to the markets. It's the belief that you can turn a small trading account into a fortune quickly.
Oh yeah, I've definitely heard that before. People talk about turning a few $1,000s into millions, but the book suggests that's not realistic, right?
Exactly. Trading is a business. And like any business, it takes time, capital, and skill to build. Starting with too little capital can actually increase your risk and make it harder to succeed.
Okay, so it's not about trying to get rich quick. It's about building a sustainable trading business over time.
Precisely. And starting with a realistic amount of capital allows you to focus on learning and growing your account gradually, without the pressure of needing to make huge returns right away.
That makes a lot of sense. It's about taking a long-term perspective
Mm.
and not getting caught up in the short-term fluctuations of the market. Now, what of the last fantasy? You mentioned there was one more that we need to watch out for.
Yes, the final fantasy. And perhaps the most insidious of them all is wishful thinking.
Wishful thinking. I can already sense this one is going to be a trap. Tell me more.
Wishful thinking is that insidious tendency to ignore evidence that contradicts our beliefs or to rationalize our losses. We all do it to some extent, but it can be incredibly destructive in trading.
So it's like putting on blinders and pretending everything is fine, even when the market is telling us otherwise.
Exactly. And wishful thinking prevents us from learning from our mistakes and adapting to changing market conditions. It's like driving with a flat tire and pretending you don't need to stop and change it.
Ouch, I can see how that would lead to a major crash. So how do we overcome this wishful thinking tendency?
It starts with self-awareness. Recognize that we all have biases and that the markets will constantly challenge our beliefs. Trading for a living encourages us to be honest with ourselves about our trading performance, to be willing to admit when we're wrong, and to adapt our strategies as needed.
So it's about having that humility and flexibility to adjust our approach as the market throws us curveballs.
Exactly. Now let's shift gears a bit and talk about market cycles. I've heard that markets move in cycles, but honestly, I don't fully understand how it works. Can you shed some light on this for us? Market cycles are fascinating. They're recurring patterns of upswings and downswings that reflect those larger economic and psychological trends that are always at play. One of the most well-known cycles is the 4-year cycle in the U.S. stock market.
A 4-year cycle. Tell me more.
Historically, the U.S. stock market has tended to experience a major bull market roughly every 4 years. These bull markets are typically driven by a combination of factors, such as economic growth, technological innovation, and investor optimism. It's like a collective wave of enthusiasm and confidence that pushes the market higher.
Okay, so the market gets excited, prices go up, and everyone's happy. But what happens next?
Well, eventually that enthusiasm starts to fade, valuations get stretched, risks accumulate, and the market begins to correct. Often sharply and painfully, this correction can turn into a bear market, a prolonged period of declining prices.
So it's like a roller coaster ride of ups and downs, driven by these waves of optimism and pessimism.
That's a great analogy. And understanding these cycles can help you anticipate those major shifts in market sentiment and adjust your trading strategy accordingly. If you recognize that a bull market is approaching its peak, you might become more cautious and start protecting your profits. Conversely, if you sense that a bear market is nearing its end, you might start looking for buying opportunities and position yourself for the next upswing.
Okay, so it's not about predicting the future with perfect accuracy. It's about understanding the rhythms of the market and positioning yourself accordingly. Now, the book also mentions seasonality in markets. What's that all about?
Seasonality refers to those recurring patterns in price behavior that are tied to specific times of the year. For example, certain agricultural commodities might be more likely to rally during the planting or harvesting seasons. Heating oil tends to be stronger in the winter months, while gasoline often peaks in the summer driving season. Recognizing these seasonal tendencies can give you an extra edge.
So it's like understanding the natural ebb and flow of supply and demand for certain products throughout the year. Okay, so we've covered a lot of ground in terms of market analysis, psychology, and even these broader market cycles. But now I'm curious about the actual process of finding and executing trades. Where do I even begin?
That's a great question. And one of the first decisions you need to make is whether you're going to be a discretionary trader or a mechanical trader.
Discretionary versus mechanical. Okay, break that down for me. What's the difference?
A discretionary trader relies on their own judgment and intuition to make trading decisions. They might use a variety of indicators and tools, but ultimately, it's their gut feeling that guides them. They're like jazz musicians, improvising based on the melody of the market.
So it's a more free-flowing, intuitive approach, adapting to the market's nuances in real time. What about mechanical traders? What makes them different?
A mechanical trader, on the other hand, follows a predefined set of rules. These rules dictate their entry and exit points, their position sizing, everything. They might use a specific trading system, like the triple screen or the impulse system we discussed earlier. It's about removing emotion from the equation and following the system's signals.
So it's like having a trading robot that tells you exactly what to do, buy or sell, based on the rules of the system. Interesting. Are there pros and cons to both approaches?
Absolutely. Discretionary trading allows for more flexibility and adaptability. You can adjust your approach based on your own interpretation of the market. However, it also requires a high level of discipline and emotional control to avoid those impulsive, fear-driven decisions. Mechanical trading, on the other hand, provides structure and objectivity. It removes the emotion from the equation, but it can be less responsive to those unique market situations that don't fit neatly into the system's rules.
So it's really about finding the approach that aligns best. With my personality and trading style, if I'm someone who tends to get emotional or second-guess myself, maybe a more mechanical approach would be a good fit. But if I thrive on that flexibility and intuition, maybe a discretionary approach would be more my style.
Exactly. And trading for a living suggests that many successful traders actually find a balance somewhere between these two extremes. They might have a set of rules they generally follow, but allow for some discretion based on their experience and judgment. It's like having a roadmap, but being willing to take a detour if the scenery looks more promising along a different path.
Okay, that makes sense. It's about finding that sweet spot between structure and flexibility. Now, I'm assuming that regardless of which approach I choose, I'm going to need to develop a trading system. How do I even begin to do that?
Developing a trading system is a journey of self-discovery. It's about aligning your approach with your goals and risk tolerance. And trading for a living emphasizes the importance of defining your key demands. What are you looking for in a trading system? High win rates, large profits, low drawdowns. Be clear about what you want to achieve before you start building all little deeds.
So it's like crafting a mission statement for my trading business, outlining my values and objectives. I like that. Once I've defined those key demands, where do I go from there?
The next step is experimentation. Test different indicators, strategies, and timeframes to see what resonates with you and what aligns with your market outlook. The book encourages the use of paper trading to test those ideas in a risk-free environment. It's a fantastic way to try things out, hone your skills, and build confidence before putting real money on the line.
Okay, so paper trading allows me to test drive different approaches and refine my system without risking any capital. Once I have a system that I'm comfortable with, is it time to go live?
Not so fast. Trading for a living recommends taking one more step before risking real money. Backtesting your system on historical data. It's like taking your time machine for a spin, running your system through past market conditions to see how it would have performed.
Okay, so backtesting helps me identify potential weaknesses in my system and fine-tune my approach before going live. That's super valuable. But I worry about making my system too complex. Is that a common mistake?
Absolutely. Trading for a living cautions against complexity. Overly complicated systems with a million indicators and rules often fail in real-time trading because they're too rigid and can't adapt to the market's ever-changing personality.
So it's back to the KISS principle. Keep it simple, stupid.
You got it. Focus on a handful of high-quality indicators and rules that you understand deeply. Don't try to incorporate every trading concept you stumble across.
Got it. Less is more. Now, you mentioned earlier that trading for a living Also talks about the psychological aspects of trading. It seems like this is an area where a lot of traders struggle. Why is psychology so important in trading, and what are some of the key insights the book offers?
Trading is as much a mental game as it is a financial one. It's about mastering your own mind, your emotions, your biases, your reactions to winning and losing. One of the first steps to psychological mastery is recognizing that we are all prone to emotional biases.
Emotional biases. What are some examples of those, and how can they impact our trading?
One common bias is loss aversion, which is that tendency to feel the pain of a loss much more intensely than the pleasure of an equivalent gain. It's why some traders hold on to losing trades for far too long, hoping they'll come back, even when all signs point to further losses.
Oh, I've definitely been guilty of that one. It's so hard to admit defeat and cut your losses when you're convinced that the trade will eventually turn around.
It is. It goes against our natural wiring to embrace loss. Another common bias is confirmation bias, which is the tendency to seek out information that confirms our existing beliefs. While ignoring or downplaying evidence that contradicts them, it's like we're selectively filtering the information we receive to fit our own narratives.
So if I'm convinced that a particular stock is going to go up, I might ignore the warning signs or rationalize away the negative news, focusing only on the information that supports my bullish view.
Exactly. Confirmation bias can lead us to make impulsive decisions based on incomplete or flawed information, and those decisions can be costly in the markets.
Okay, so we've got loss aversion and confirmation.